Joining me today to unpack opportunities within the alternative space and the range of products Fidelity could offer is alternative investment strategist Brendan Sims. Welcome to you. Great to see you.
Pamela, thank you very much for having me.
Delighted to have you here, Brendan. And we just said exactly what your title is. We're going to sort of go over the overall strategy that Fidelity provides. I'm kind of curious why we still think it's new. I mean, go back to when this began and why isn't everyone doing it already?
That's a great question. So we're about 3.5 years new into the space ourselves here at Fidelity. I think we were afforded the flexibility to move into this space as early as just over 4 years ago. So late 2019 that was. And I think that it's a great thing that these flexibilities were given to us and sort of other competitors within the retail landscape, because it affords not only us, but others to provide more innovative solutions to the retail landscape that necessarily weren't there before.
And I mean, some people, we'll just introduce us a little bit. A lot of people joining you here today have heard of them, but some people say, well, it's a hedge fund, which is good and bad. Hedge funds used to be not available to most investors. We're talking about retail investors here. To what extent is that true?
Yeah, no. So, I mean, hedge funds, as far as a term and the way people think about them today, it's often tied to 10, 15, 20 years ago, and maybe some wrongdoings from those time frames. So if we fast forward today, the word hedge fund can absolutely be used to describe the style of investing that is deployed within these vehicles. That said, what they're going and what they're striving to achieve is very different than the conventional hedge fund that we know and think about from the 90s, early 2000s.
So the aspect of this is the ability to short. And that's, as you say, 4 years ago, regulations changed. That was then allowed in certain situations. And that's how these products ultimately have come to bear. What does shorting allow?
A number of things. It increases flexibility that the portfolio manager has at their disposal. It in and of itself is a source of leverage. So when you sell a stock short, it provides you with cash that is not the initial invested capital from the investor. And I think that having that dry powder, the ability to have cash on hand, the optionality to deploy it at a later point in time is sort of where that flexibility comes from.
And where we'll go through this a couple of times because it always bears repeating, but where do alts belong? Are they always as a sleeve, as a diversifier? Do they sometimes belong as a core position in one's portfolio? Give us a sense of where they can belong and do belong.
Yeah, so I've chatted and met with advisors across the country, and how these vehicles, if you would, are used it varies greatly depending on different advisor outlooks and different books of business and sort of where they've come from in their track record of using alternatives. So I've chatted with many advisors that have for a long time used offering memorandum style of investing, whereby there's immense amount of paperwork and legalities. It typically was reserved for accredited investors only. And there's lack of transparency, higher barriers to entry, you name it. I think education is a big component. So the question I always get is, what's the optimal allocation for alternatives?
Well, what is it?
Unfortunately, there isn't a concrete answer.
Okay.
It really is a spectrum, and it always ties back to what is the investor's objective, or better yet, what is the overriding objective of maybe a model portfolio that an advisor is breaking out into different allocations.
So if you were to talk about sort of bringing things into the world today, here we are in 2024, the markets have been wild over the course of the lives of these products, actually, that Fidelity has offered, and we'll go into those a little bit in a minute. What are the trends today? What are you seeing today in terms of the alt space?
I'd say product development is a big one. I mean, these things weren't here several years ago, and now they are. But I think they have a long way to go with respect to the flexibilities that have been brought forth and what we can bring forward as far as innovative solutions. So here at Fidelity, we're not always first. We don't always rush to market. We often are slow, methodical, using our resources best at hand to, I guess, match market demand for innovative solutions with what we have core competencies in. Okay. So it's no surprise that our 4 minutes that we have today play heavily on the capability of shorting.
Okay, so let's go through them. So you've got the market neutral. We'll swing around to them again, but you got market neutral, which will help you do essentially avoid something like massive volatility in the markets, which we had 3 weeks ago. How long ago was that? That was a really crazy time.
3.5, 4 weeks ago,
Yeah.
was the carry trade unwind. I think there was some sort of renewed sentiment around the likelihood of a recession and some bad jobs numbers.
Right. And so market neutral in that sense allows you to kind of sail through.
I would say so. If we were to break our lineup of 4 offerings into 2 sides, we have equity enhancers on one hand, and we have diversifiers on the other. So a strategy like market neutral, that is stripping out the beta or removing the systematic risk of markets, and really just tapping into the relative differential of picking great stocks long and less great stocks on the short side in a paired trade fashion. That's market neutral investing. And it's a great way to achieve a steady return stream that might not be as correlated to other traditional asset classes like long bonds or stocks.
Okay, so as you go through a period of volatility, for instance, it could be sort of a place to hide.
Yeah, absolutely.
Yeah.
Per se hide,
Well,
hedge,
okay.
be an alternative to cash. Whether you take that position from equities or fixed income, that's also a question I do frequently get.
Yeah.
And again, it all ties back to the investment objective. Like if you're
Yeah, oh, sorry, I was just gonna say, so diversifiers and equity enhancements, let's just go back to some of the other funds. So you've got the global value long short, for instance. Where does it fit? Equity enhancer or diversifier?
It would fit, in my opinion, on the diversifier side.
Okay.
And that's up to how you're looking to hold it and what your sort of use case is. But I would see that as a great opportunity to diversify one's portfolio. The fund has shown a potential to have an inverse correlation to the growth theme or the growth factor, if you would, which in today's world, in meeting with advisors, we observe portfolios that are more large cap dominant, US bias, growth and infotech heavy. The opportunity to implement a hedge, if you would, to something that's going to behave differently is always of value.
We speak to David Way quite often. His fund, which equity enhancer, diversifier, where does
Yeah, so that's long short alternative with David Way. It's absolutely, in my opinion, on the enhancer side of things. You're going to have market exposure to North American equities through and through. Dave believes in being exposed to risk over time, that markets reward those who bear risk. But he wants to be exposed to North American equities in a more risk-conscious manner for a better investor experience. And that's where shorting comes into play, is the ability to create that ballast or a buoy to the vol on the long side of the portfolio.
Yeah, he'll often talk about that conviction for long. It allows him to go more conviction for his long ideas by having this.
Yeah, like I mean, the ability to short allows him to take the long portfolio to areas that he might not otherwise do on a standalone long basis. It gives him the ability to hedge some positions, gives him leverage, as we touched on earlier. And really, it allows him to tap into both his convictions and the thoughts of our research teams. I always say, prior to the ability to short, the best we could do is zero out a name that we really didn't like. And I think that there's a big case.
Like just avoid it.
Just avoid it.
Yeah.
So underweight it, goose egg. Couldn't go below zero, if you would. I think the ability to underweight or sell stock short is allowing us to sort of put forth our true views on markets. And we do all this research. I think it's great that we can tap into both sides of the trade.
So those are the three funds that were launched in the neighborhood of 3 years ago.
Yeah.
They've been available. There's another fund as well.
Canadian Long Short. It's managed by Ritu Kumra, and it's an interesting fund. We won't get into the intricacies, but what I would say is that it's going to be 100% net exposed to the TSX. It's 130% long and 30% short. So very much, if you're a believer in active management and you're interested in sort of enhancing your TSX type of exposure, the Canadian Long Short Fund look no further.
Really, really interesting. Again, maybe just go back to some of the research that, as you say, that comes into that fund particularly. But there's so much research, which is what Fidelity is known for. How does this come to bear differently, for instance, in alts? We'll just kind of swing back to what's in these alts and how that research comes to bear.
Yeah, I mean, we work so hard on the research front and we turn over so many stones, meet with management to come up with best-in-class ideas. And I think that the capabilities, if you take a fund like Market Neutral, for example, I call it a pure stock pickers fund. You're not riding the highs or lows of markets from interest rate announcements, jobs numbers, et cetera. Your return profile is concentrated to the ability to pick great companies on the long side and identify relative losers on the short side. And what those paired trades would look like are companies with very similar revenue profiles, expense profiles that would be affected by, in a very similar way, to different sort of macro shocks and themes.
Sometimes in the same sector even.
Absolutely in the same sector. You could even go a step further in that, almost in the same subsector with competitors directly, if you would. So relative stock picking.
Yeah, it's really fascinating. Alts can mean so many different things because it's just a catch-all alternative. You've described ultimately the products that are offered here at Fidelity, but how do you sort of navigate? You must look at the broader offering in the alts world. How do you kind of zero in on these ones? How does Fidelity zero in on these ones? And what else is out there circulating that you got your eye on?
Yeah, so there's about 45 billion within the Canadian landscape of
Okay.
what we would deem to be liquid alternatives. And it's a growing number. I'd say that in 2023, it was the fastest growing identifiable asset class by percentage or rate of growth. And what I would say is out there are many vehicles out there that are using different types of exposures. Those that are maybe managing FX, using leverage in its purest form, or borrowing against the fund's NAV. There are vehicles that would utilize options on both sides of the trade, long and short, purchasing of as well as writing them. And other forms of, call it synthetic exposures, where you're not actually owning the underlying, but you might be using a form of a forward or a future to gain exposure to an asset class.
And at the moment, this is not what Fidelity's offering.
At the moment, what we've done is we've jumped in where our core competency is, which is identifying great companies long and short. I think that there's a ton of capabilities out there, which our product development team is tirelessly working towards. We have our partners south of the border at Fidelity in the US. We have third parties, which we can and have called upon. We have a great strategic agreement with Brookfield, for example, where we're tapping into their
private market. This is going to real estate.
You got it. Yeah. So their capabilities with respect to being best in class from underwriting, transacting, and sort of the continual operation management of core Canadian real estate assets.
Can you say more about that? Real estate's kind of front and center these days.
Yeah, no, I mean, it's an interesting time, but I mean, no one made money when it was comfortable, right? So I think that going shopping in the Canadian landscape from a real estate capacity, when others are maybe exiting the space or transacting because they need to, I think it's a really great time to be going in with dry powder, to have the patience, but really the opportunity to go into other asset classes and be patient for great opportunities to come your way. So it's our private investment pools, or PIP suite of funds, that has sort of earmarked 5%. We're not quite there, but we're working towards allocating up to 5% to private Canadian real estate. And you touched on it. It's a precarious environment right now. What comes to mind is office and call it like plazas and commercial storefronts. We have the work from home trend as well as e-commerce that are working against those spaces. That said, in time, things do turn over and there's sort of price discovery, but we're finding great opportunities in the multifamily and industrial logistics space.
Fascinating. That's so fascinating, so interesting. And access to that, or to having that type of offering within a portfolio, again, would provide, and I appreciate it's a certain amount within a fund, but is that adding sort of, it's not an equity enhancer, it's really a diversifier, right?
I would call it a diversifier.
Yeah.
These are less liquid. I wouldn't call it illiquid, but these are a lot less liquid assets. These are large buildings. These are shipping yards, cold storage facilities, you name it. And over time, when you underwrite the deal, you want to make sure that you're getting in at a good price that makes sense for your unit holders. And I think that's where a lot of the work is done to ensure long-term success. But all in all, these are assets that are going to be less correlated to interest rate shocks and sort of other headline announcements than the rest or the existing components of one's portfolio.
So some of the managed products, the GAA ultimately offers, some of the funds that are there, are they using alts? So I think we've spoken to some of the GAA team and they seem pretty interested.
Yeah, so that ties into the Q2 announcement from earlier this year that our asset allocation team has taken conviction towards our existing 3 alternatives that have that 3.5 to 4 year track record. What they've done is they've utilized multi-asset based funds to incorporate a sleeve of alternatives to their existing managed portfolios. That's the FMP suite of funds.
As diversifiers?
As equity enhancers as well as diversifiers. So what I would say is that each market neutral, global value long short, and long short alternative are being utilized in different capacities within the existing managed portfolios. And if we take a growth mandate or a income oriented mandate, we might not make the same allocation to each of those respective 3 mandates, because again, tying it all back, they have different investment objectives.
For sure.
But all in all, what they stand to do is provide an enhanced risk profile as far as the standard deviation and return capability.
And I don't know if we use the GAA, what their offerings ultimately are as an example, but generally speaking for alt, so we'll just kind of move into a different section. Is it fitting on the 60 or the 40? This is always the question. And the answer is often, it could be either, but But is it fitting on the 60 or the 40?
So the answer is either. And if you want an answer today, I would say if you took a growth mandate, like let's take an 85-15 in favor of equity, you're likely to be probably taking it from the equity and supplementing with something more like long short alternative. Because again, back to an 85-15 or a growth mandate, capital gains and or growth is certainly top of mind relative to stability and preservation. If you flip to the opposite side of the spectrum, you might be making a greater allocation to something like market neutral or global value long short to hedge, preserve, and protect. So it's all investment objective driven. And as far as I've heard some terms thrown around, we have the 60-40 that is often picked on. Do we go to like a 60-20-20? Is it a 60-30-10? Like, what is this ideal allocation? And the answer is, it depends. I think that some allocation, some number assigned to alternatives is definitely the way going forward.
It's a diversifier, which is what you want in a 60-40 out of a bond portfolio, that side. So does it replace bonds to an extent?
I'm going to say it again, but it depends, right? So 2022, you look, stocks and bonds moved in tandem with one another. It made for a very challenging year for balanced medium risk investors.
Bond investors will say that was transitory.
Sure. I mean, you can talk about, that was the initial view on inflation, was that it was transitory. We thought that we were staying in a lower rate environment for longer. It didn't last nearly as long as anyone had thought. Even those that maybe thought it would be short-lived, it was likely shorter. So my thoughts there is that it was about the onset of the COVID pandemic or early 2020 that if we were to chart sort of the S&P 500, the US Ag, and look at the correlations, that they flipped into positive territory. And we have been in positive territory for a historically significant period now. Where things go, we just had a bit of a dovish tilt from the announcement just last week. But what I would say is that nothing is certain going forward.
You're talking about US interest rates.
Yeah, US interest rates, and even that from TIFF here in Canada and sort of the outlook for the Canadian space. I think that despite recent dovish tones, we do need to be cautious around the risk that stocks and bonds continue to be positively correlated. And that's where something that comes in when you can introduce a high quality asset that has a correlation to other building blocks, that has like a 0.3 to a 0.7 correlation to other components, but is providing a source of return. I think that's a win from dampening volatility and sort of hedging the risk around that positive correlation.
Fascinating. So what can you tell from the performance of some of these strategies? Like for instance, we'll watch the bond market to take a look at spreads and, as flags, basically. Is there information, is there data that is produced from watching the performance? These are new, I understand it, but actually they've been in place at Fidelity for over 3 years. It must be interesting to sort of watch within the flows and the performance of how well are they doing for what they're meant to do?
I would say very well. At different points in time over the past 3.5 years, each of the original 3 managers, as well as our new Canadian long short, have achieved success in what looks like very different ways. So for market neutral, what I would want to see out of a fund like that would be steady returns on a rolling 1-year basis, such that at any given month, whether it be February or November, if an investor looks at their statement, they're looking to see a mid to high single-digit return figure in a reasonably reoccurring fashion. Yeah. For long short alternative, what that's going to look like is market relative returns to the North American benchmark, be it half and half S&P 500 and TSX, with a meaningfully reduced volatility profile. Global value long short, Dan's working tirelessly to find opportunities to invest on the long side in deep value names, and on the short side, exploit what he believes to be temporary mispricings from a valuation standpoint.
Yeah, fascinating how all of that ultimately works and how that, do you think, I mean, there are those, I'm going to ask you a market question now. There are those that say that vol is just going to be, it's going to be high for the next while because we're kind of shaking out of a really weird time. So if you wanted to go with sort of a low vol, again, something to protect against that, I guess I'm just sort of throwing out, I'll ask you about the carry trade in a minute, but this idea of vol being elevated, how would alts help you? How could alts help you in that situation? There's a fund for that.
Yeah, I mean, there absolutely is. If you're looking to hide from that and you don't necessarily want to,
some people want exposure to it. Yeah,
some people might want exposure to it. They're willing to ride that volatility. But if, say, you're looking to hide from it, you can go to cash. You can use GICs, you can use short-term fixed income. Well, if you have sort of a problem, whether it be the liquidity of GICs or the sensitivity to interest rates, even on the front end of the curve, look no further but then to a mandate like market neutral that might not be subject to these same shocks. And it's not to say it's better, but it's just a third ingredient in something that in the space where someone is looking to sort of take some off the table and insulate their portfolio. Maybe use it as a liquidity sleeve that is greater than cash, but more liquid than that of a 1-year GIC.
Fascinating. Take us, you are speaking with advisors here right now. You speak to advisors all the time. What do advisors think? You mentioned a couple of thoughts off the top. Are there some examples of, you have to kind of sit down and break apart what this strategy is? Tell us a little bit about those conversations.
Yeah, for sure. So, I mean, there are those out there that would say that over time, equities outperform most alternative mandates. And I wouldn't necessarily try to argue with them. They're likely right, but it's about the experience in the interim. So for those that are looking to maximize returns over 10 to 20 years, and they have a long track record in front of them, maybe there's less of a case for diversifiers or the global value long short or the market neutrals of the world or other sort of merger arb type solutions that are out there. We don't have one, but there are these capabilities that are unique in and of themselves, but over time are likely going to provide inferior returns to an efficient index like the S&P 500.
Right.
So I think we do need to be cognizant of those viewpoints. And then on the flip side, there are advisors who are looking to insulate. Maybe they run a book of business with older clients.
Insulate, yeah.
And they maybe say a half or a third of their book is already riffing. And capital preservation is paramount. And they've had a tough time with that over the last 2 to 3 years. Fortunately, equities have provided a nice buffer.
Yeah.
Portfolios have gone up substantially relative to sort of expectation at the onset. But the question lies, how do we insulate from future events? You mentioned the carry trade earlier.
Yeah, let's pick that apart again, because there are those that will argue that it's done. And there are those that will argue it's still kind of working its way through. I mean, I don't know. But if you're worried about that, again, you might want to approach that in a certain way.
Yeah, I'm not going to take a stance on whether it's done or there's more work to be done. But what I would say, and I touched on it earlier, was the carry trade was kind of the straw that broke the camel's back. The markets had been sort of neglecting the reality of a recession for a long time. It was very glass half full on a year-to-date basis, as well as 2023. Between that, poor jobs number on the week prior leading up to the August long weekend, it was sort of a trifecta with the dumping of securities from the carry trade sort of really just polished it off and caused for really global turmoil for what was a short period of time.
Yeah.
But I think that at this point in August, it was a good reminder to investors that portfolios don't just go up and to the right, and that these corrections of 5% or more, they're very normal and they happen a lot more than we perceive. I think that our memories can only go back so far, and we condition ourselves that way. But I think that if you look
when you're in it, you're thinking, holy smokes.
Absolutely. So I think if anything, it's a great time to allow investors to recalibrate, remind themselves, check in with your investment objective. What did you set to do? And does your current portfolio align with those objectives and views?
Okay. And you now literally have more options to do that with. Anything else to say on sort of where we see other types of alts being developed? So what's going on at Fidelity to take a look at some of these? You said working really, really hard. Can you give us any hints to which areas of the alternative universe beyond the Brookfield discussion?
Yeah, I'm not necessarily going to give any hints necessarily, but I'll tell you what excites us.
Try though,
yeah,
right?
you can absolutely try. Well, I'll tell you what excites us. I think that the capability or the option to use capabilities, that extend beyond the traditional long short investing framework, like that of using leverage or borrowing against the fund's NAV. That's something exciting. It could be applied to a new mandate or maybe to an existing structure within our lineup. Also, the ability to utilize options, whether it be from a writing or purchasing standpoint, to either enhance exposures, generate a source of option premia, to allow for yield for investors. That's something that is enticing. As well, real estate. I think that what we're doing in the real estate space is really, really exciting. But there's a ton of opportunities out there, sort of what we can see here in front of us and beyond for the years to come.
And just remind us sort of, what do? You cover these funds very closely. You ultimately are interfacing with advisors. What kind of other just questions? What's the question you get most often? You mentioned one of them. Just what would be another one that we could answer for everyone right now?
I would say the question would be why alternatives? If I haven't used them at this point in my career, why now? And I always say the best time to introduce them would have been yesterday.
Right.
And on that, if you had this capability in 2005, would 2008 have been as rough of a ride if you were using these in a meaningful way within your practice? And not to pick on GFC, We could definitely choose a more gentle example.
A more gentle recession? for
Yeah,
instance?
exactly. But I do think that this is a new capability. So the why now for that advisor who's maybe giving some pushback, not looking to implement these today because they maybe haven't their entirety of their career. The answer would be because we have the capability now. And the other question, which we touched on earlier, is the allocation. I always say that the allocation starts at 10% to alternatives. Reason being, less than 10, you're not necessarily going to have an observable, quantifiable difference, whether that be in a quarter, a downturn, or a calendar year, for example. So it starts at 10. Conversations, depending on the building blocks that you're using, they go as high as 30, 40%. If you read into family office reports and sort of how the higher net worth community is managing money, oftentimes it's 40, 45 some odd percent of one's portfolio is something that is, I'm not even going to say alternatives, but not a traditional stock, bond, or cash.
Okay, really interesting. We'll leave it there. Brendan Sims, you've covered a huge amount of territory for us. Thank you very much for kind of explaining, going through and taking a look at why it's important right now. We're in a really fascinating part in the market. So have a great long weekend.
Thank you very much, Pamela.